Welcome to the Deep Dive. I'm genuinely excited about today's deep dive because, look, we're plunging into one of the most dynamic, rapidly evolving financial landscapes anywhere in the world. India's financial sector as of June 2025.
It really is moving fast.
Exactly. And if you've been following the global headlines, you know why this is such a compelling story. Just think about this. India's Unified Payments Interface, UPI. It's recently done something truly remarkable.
The Visa news.
Yes. It's officially surpassed Visa as the world's largest retail real-time payment system by daily transaction volume. I mean, that's not just a statistic, right? That's a fundamental shift.
Absolutely. It really signals India's pivotal role in shaping, well, the future of digital payments globally.
Our mission today, as always, is to navigate this really comprehensive stack of financial news, these crucial regulatory updates, and the latest economic reports from the past month or so.
A lot to cover.
There is. We're going to pull out the most important insights, maybe some surprising facts, and those key takeaways that give you a clear, actionable understanding of what's genuinely happening. You know, in India's fast-moving economy and its vibrant financial system.
Sort of cutting through the noise.
Precisely. Think of it as your shortcut to being well-informed without having to wade through endless articles yourself.
Makes sense.
Over the next little while, we'll be covering some broad, interconnected categories. We'll start by setting the stage with the big-picture macroeconomic trends, the stuff influencing everything else.
The foundation.
Right. From there, we'll zoom in on the core of the financial system, the health and performance of India's public sector banks. And they have quite a story to tell.
Oh, definitely. A big turnaround.
Then we'll dive deep into that groundbreaking digital payments revolution, which is really changing how people transact every single day. UPI and beyond.
Can't ignore that.
And finally, we'll wrap up with the crucial regulatory shifts impacting the capital markets. SEBI's been busy, so get ready, because there's a lot to explore. All right, let's jump right in. When we talk about the central bank, the Reserve Bank of India, the RBI, they really made some significant moves in June 2025, sent ripples across the entire financial landscape. What was the big news on the monetary policy front that had everyone talking?
Well, the most prominent decision, the headline grabber from the RBI's Monetary Policy Committee, the MPC, was that repo rate cut. They cut it by 50 basis points.
Okay, 50 basis points.
Yeah, bringing it down to 5.5% in June 2025. And, you know, this wasn't a sudden, isolated decision. It actually marked the third consecutive cut since February.
Right, so a clear trend.
A very clear trend. This consistent downward movement sends a pretty strong signal to the market.
And what is that signal, strategically speaking?
Well, if we connect this to the broader strategy, this decision signifies, I'd say, a nuanced shift in their policy stance. They've moved from an accommodative position.
Where they were pushing growth.
Exactly. Actively trying to stimulate growth, often keeping rates low. Now they're in a more neutral stance. What this implies is a delicate balancing act for the RBI.
Okay.
They are now trying to support continued economic growth, you know, perhaps through more affordable credit, while simultaneously keeping a very close eye on inflation, making sure it doesn't get out of hand as the economy picks up.
Finding that sweet spot.
That's exactly it, finding that sweet spot where the economy can expand robustly without prices, you know, spiraling upwards.
Got it. And were there other rate adjustments alongside the repo rate?
Yes, they also fine-tune other key rates, the ones that play a role in the banking system's daily liquidity. The Standing Deposit Facility, or SDF, that's now at 5.25%.
Okay.
The Marginal Standing Facility, MSF, is 5.75%, and the bank rate also stands at 5.75%.
So these are like the RBI's precision tools.
That's a good way to put it. While the repo rate sets the big benchmark for borrowing, the SDF and MSF create this narrow corridor, right? Essentially setting the floor and the ceiling for overnight interest rates.
Right.
This helps the RBI manage that daily ebb and flow of money and, crucially, ensures stability in short-term lending.
And you mentioned liquidity. Was there anything else impacting the amount of money in the system?
Oh, absolutely. Perhaps one of the most impactful moves for overall liquidity was the announcement of a phased reduction of the cash reserve ratio, the CRR.
Right. The money banks have to keep with the RBI.
Exactly. Funds they cannot lend out. The plan is to gradually reduce it to 3% of net demand and time liabilities, NDTL, by December 2025.
And that's significant because?
Because this phase reduction is estimated to infuse approximately 2.5 lakh crore directly into the banking system.
Wow, that's a huge number.
It is. What this means for liquidity is a substantial increase in funds available for banks to lend out, to businesses, to consumers. which should, further support investment, consumption, overall economic activity.
So a direct injection of capital.
A direct injection designed to grease the wheels of the economy.
That's a significant infusion of liquidity and a clear direction on rates from the RBI. But, beyond just the money supply, what's the overall health of the Indian economy looking like? How are we doing on growth, prices, and what's the general feeling of the sentiment on the ground?
Yeah, let's do that broad economic health check. The outlook for FY26 GDP growth, well, it remains quite robust. Both the RBI and S&P are projecting a solid 6.5% growth rate.
6.5%, okay.
And gross value added, GVA, growth is estimated at 6.4%. This projected growth is primarily underpinned by strong domestic consumption, increased capital expenditure, both government and private sector.
CapEx.
And the crucial factor, always, of a favorable monsoon. Still vital for India's economy.
And how does that 6.5% compare with other forecasts? Is there consensus?
There's a broad consensus, actually. It aligns pretty closely with other major institutions. The OECD projects 6.3%, UBS is at 6.4%, Nomura and ICRA both see 6.2%, and the World Bank is at 6.3%. So yeah, general agreement around a healthy growth path for India.
That's encouraging. Now, what about the inflation story? That's often the other side of the coin.
And it's a compelling story right now, quite a relief for consumers, actually. The Consumer Price Index, CPI, inflation, is projected at a very manageable 3.7% for FY26.
3.7%, that's quite low.
It is. It's expected to be even lower in Q1, around 2.9%, before rising slightly to 4.4% in Q4. But that 3.7% projection for the full fiscal year is particularly noteworthy because it marks the lowest CPI inflation in 6 years.
6 years? Wow. What's driving that?
The main drivers are quite clear. Wholesale price index, WPI, inflation dropped to a remarkably low 0.39% in May, largely due to easing food and fuel prices.
Okay.
And that decline in wholesale prices is naturally trickling down to retail. In fact, retail inflation also fell to a 6-year low of 2.8% in May, directly benefiting from deflation in key things like vegetables, pulses, spices.
So widespread easing.
Exactly. And that's a huge boost for household budgets, right? Consumer purchasing power.
Makes sense. And how is that reflected in consumer confidence? Are people feeling optimistic?
They are. The confidence surveys reflect this positive outlook. The Urban Consumer Confidence Survey, the CSI, stood at 95.4, with the Future Expectations Index, FEI, rising to 123.4.
Okay.
This indicates general optimism about future income, job prospects among urban consumers. And in rural areas, the CSI hit a perfect 100.0.
100.
Yeah. And the FEI climbed even higher to 126.2. This strong rural confidence is directly linked to those favorable monsoon predictions, good harvests expected, and of course the lower food inflation we just talked about.
Leaves more money in their pockets.
Precisely. More disposable income in rural households.
But are there any clouds on the horizon? Any risks the RBI flagged?
Yes, it's not without potential headwinds. The RBI has flagged some important risks. Things like potential climate disruptions, ongoing global trade uncertainties, and persistent geopolitical tensions.
The usual suspects, unfortunately.
Yeah, right. These are factors that could, if they worsen, impact India's economic stability and growth. So, while the immediate picture is positive, vigilance and careful monitoring remain absolutely key. And if we zoom out a bit, connect this to the bigger picture. Understanding how India is positioned globally, especially with its external accounts, is incredibly important.
Right. A country's strength isn't just domestic.
Exactly. It's also about resilience in the global economic arena. On the foreign exchange front, India's Forex reserves have shown a healthy, consistent increase. They rose to a substantial $696.65 billion in June 2025.
That's a big number. Provides a buffer.
A very strong buffer against potential external shocks like global currency volatility or unexpected import surges. It reflects growing financial stability and economic strength.
Okay. And the current account. I know the deficit has been a focus area.
It has, and there's good news there. India recorded a significant surplus of $13.5 billion in Q4 FY25.
A surplus.
Yes, a very positive development. It means the country earned more from exports and remittances than it spent on imports in that quarter. This surplus helped the annual current account deficit, the CAD, narrow substantially to $23.3 billion for the full fiscal year.
Which means less reliance on foreign capital.
Exactly. It signals greater self-sufficiency and financial health.
What about external debt? Has it been rising?
It has risen in absolute terms, yes, to $736.3 billion, which is about 19.1% of GDP. While it's an increase, its proportion to GDP is still considered manageable within international norms.
It's something to watch.
Always. Especially with global interest rate movements and currency fluctuations, those can impact the cost of servicing this debt.
Right. Yeah, foreign direct investment. FDI trends. Always a key indicator of confidence.
And they've been particularly encouraging. Gross FDI surged by an impressive 23% in April, and net FDI actually doubled to $8.8 billion.
Doubled. Wow. Where's it coming from?
Top sources continue to be Singapore, Mauritius, and the United States. Well-established investment corridors there. Domestically, Maharashtra and Karnataka remain the magnets, jointly attracting 51% of the inflows in FY25.
Highlights their economic dynamism.
Absolutely. Strong industrial bases, favorable investment climates.
Okay, and trade. The trade deficit.
That narrowed to $6.6 billion in May 2025. Total exports reached $71.1 billion, up 2.8%, primarily driven by a robust 9.4% growth in services exports.
Services sector going strong.
Continues to be a major earner of foreign exchange,
Yeah.
IT, business process outsourcing, showcasing global competitiveness and high-value services.
Any areas of concern in the external picture?
There is a slight area of concern, actually. Core sector growth slowed down to 0.7% in May. This was notably impacted by contraction in key foundational sectors like oil, gas, and electricity.
Crucial sectors.
Very crucial for industrial output and energy supply. So it suggests some underlying headwinds in these specific areas that bear watching, even as the broader external performance generally looks positive. A reminder that the big picture might look good, but certain elements still need attention.
That's a really comprehensive look at the macro landscape.
Mhm.
Resilience, growth, but yeah, a few areas to keep an eye on. So with these broad shifts happening, what does this all mean for the backbone of our financial system, the public sector banks? For a long time, there was, let's be honest, skepticism, even concern about their health. But it feels like there's a real turnaround story unfolding. What are the latest figures telling us?
You've hit on a crucial point there. The public sector banks, PSBs, they have indeed undergone a remarkable transformation, and that story is clearly highlighted in their annual review for 2025. For years, they grappled with significant asset quality issues, right? Burdened by non-performing loans.
The NPA problem.
Exactly. But the latest figures are genuinely impressive. They signal a fundamental shift in their fortunes. The most striking highlight, their collective net profit. PSBs collectively posted a staggering net profit of 1.78 lakh crore in FY 2024-25.
1.78 lakh crore, that's huge.
It's not just a good year, it's a record-breaking performance. Marks a significant milestone, signaling a profound improvement in operational efficiency, overall profitability.
And what about those NPAs? Has that situation improved?
Dramatically. Equally significant is the improvement in asset quality. Their net non-performing assets, net NPA, fell to a multi-year low of just 0.52%.
0.52%. Can you just remind us what net NPA means again?
Sure. So an NPA is a loan where the borrower hasn't paid interest or principal for typically 90 days. Net NPA means these bad loans are reported after the bank deducts provisions money set aside to cover potential losses. So a net NPA ratio as low as 0.52% is extremely significant.
Why is that so important?
Because it indicates the bank's balance sheets are much cleaner, their loan books are healthier, they've adequately provided for potential losses, significantly reducing future risks. It's a crucial indicator of their financial strength, stability, and importantly, their willingness to lend, which is vital for economic growth.
Right. Healthier banks mean more lending. What about overall business growth?
Also robust. Total business that includes both loans or advances and deposits increased from 203 lakh crore in FY23 to 251 lakh crore in FY25.
Quite an increase.
Demonstrates their expanding reach, increased financial intermediation, channeling funds effectively across the economy.
And this strong performance, does it benefit the government too, as the owner?
Directly. Dividend payouts surged from roughly 21,000 crore to nearly 35,000 crore, so 34,990 crore to be precise.
That's a big jump.
Clearly illustrates the tangible financial contribution these public entities are making back to the national exchequer. Reinforces their value.
And are they well capitalized? Enough buffer against shocks?
Yes. From a capital adequacy perspective, their capital to risk-weighted assets ratio, CRAR, stood strong at 16.15% as of March 2025. This ratio measures capital against risk-weighted assets, a key indicator of ability to absorb losses. A high CRR means they are well-capitalized, resilient, prepared.
Okay, so the core financials look strong. Are they also contributing to broader economic goals? like supporting small businesses or financial inclusion.
Absolutely. Beyond these core metrics, PSBs are playing a crucial role. Under the new credit assessment model for MSMEs, launched in March 2025, they sanctioned an impressive 1.97 lakh loans worth 60,000 crore.
That's significant support for MSMEs.
Vital, fostering entrepreneurship, generating employment, driving dynamism at the grassroots level. And in terms of financial inclusion, there's a big saturation campaign plan from July to September 2025, ambitiously covering 2.7 lakh gram panchayats and urban local bodies.
What's the goal there?
Widespread access to essential financial services, providing focused support for various government schemes directly to eligible customers, deepening financial access across the country, ensuring no one is left behind.
And are they exploring new avenues for growth?
They are. PSBs have been actively encouraged to participate in new opportunities presented by GIFT City.
The financial hub in Gujarat.
Right. And the India International Bullion Exchange, IIBX. These avenues represent exciting new growth frontiers, opportunities for diversification, allows them to expand into international finance, commodity trading. And what's truly fascinating here, I think, is how the RBI isn't just reacting. It's proactively building resilience through, well, better data quality and clearer rules.
Being proactive, not just reactive.
Exactly. This forward-thinking approach is fundamental to ensuring the stability and integrity of the whole system. One key initiative, the Improved Supervisory Data Quality Index, SDQI, for scheduled commercial banks.
SDQI, what does that measure?
It improved significantly to 89.3 in March 2025. It basically evaluates the accuracy, timeliness, completeness, and consistency of the data banks submit in their regulatory returns to the RBI.
Why is that so important?
Because high-quality, reliable data is absolutely essential for effective supervision, accurate risk assessment, informed policymaking. You need good data to make good decisions. The RBI categorizes scores. Above 90 is good, 80-90 acceptable, 70-80 needs improvement, below 70 not acceptable.
And how did different types of banks score?
Interestingly, small finance banks, SFBs, scored the highest in March 2025 with 90.6, firmly in the good category.
Okay.
Public sector banks saw a slight dip to 88.8, but still comfortably acceptable. Private banks were at 89.6, foreign banks 89.1, also acceptable. This ongoing monitoring, it covers 87 banks, major regulatory returns like asset quality, capital adequacy, ensures a continuous check on data integrity. It's like making sure every cog in a complex machine is precisely calibrated.
Makes sense.
Yeah.
What about rules around specific types of lending, like project finance?
Another crucial development for risk management is the RBI's final Project Finance Directions 2025. These new rules introduce revised provisioning norms.
Provisioning being money set aside for potential losses.
Exactly. Mechanisms to ensure banks set aside adequate capital to cover potential losses from these large, complex project loans. For under-construction commercial real estate, CRE loans, the provisioning is 1.25% of the loan amount.
Okay.
For under-construction infrastructure projects, it's 1%. Once these projects become operational, the risk reduces, so the rates are significantly lower. 1% for CRE, 0.75% for CRE residential housing, and just 0.40% for other operational projects.
So it's a buffer.
A prudent, forward-looking measure to protect against defaults and ensure financial stability, a crucial buffer for banks.
Do the new rules offer any flexibility for developers? Project timelines can be complex.
They do. The new directions provide clearer guidelines on the date of commencement of commercial operations, or DCCO, allowing maximum extensions of 3 years for infrastructure projects and 2 years for non-infrastructure. Acknowledges the complexities while maintaining discipline.
And do these rules apply to existing projects?
Importantly, no. They are non-retrospective. Existing projects under construction that already achieved financial closure operate under the older norms. Prevents disruptive retroactive application.
Okay. Any other key points in those directions?
Yes. For very large projects, aggregate exposure over 100 crore individual lenders must contribute at least 150 crore or 5% of the total exposure, whichever is higher. This creates an exposure floor. Ensures meaningful financial participation and responsibility from each lender involved. Reduces the risk of a free rider problem where some lenders don't pull their weight.
So the RBI isn't just setting broad policy. They're really getting into the granular details of how liquidity operates, actively managing the money flowing through the economy. How are they achieving that on a day-to-day basis?
Precisely. Liquidity management is a continuous, highly active process for the RBI. Think of it like constantly adjusting flow valves in complex plumbing. To manage surplus liquidity, for instance, the RBI recently announced a 7-day variable rate reverse repo auction, a VRRR option worth $1 trillion.
VRR, that's where the RBI borrows from banks.
Exactly. It's a liquidity absorption tool. The RBI borrows funds from banks at variable rates determined via auction. This helps drain excess money from the system, preventing inflationary pressures.
Making sure there isn't too much money chasing too few goods.
Right. And it keeps short-term interest rates stable within that desired corridor we talked about.
Clever. Any other moves to manage liquidity or market operations?
Yes, in a shrewd move to enhance both liquidity management and operational efficiency, the RBI announced an extension of trading hours for certain crucial interbank markets.
Okay, which ones?
Effective July 1st, 2025, trading hours for the interbank call money market, where banks borrow and lend to each other overnight, basically will be extended from 5 p.m. to 7 p.m.
Longer window.
Yeah. Then, from August 1st, the repo and tri-party repo, TREP, markets, those involved borrowing against collateral, will see hours extended from 3 p.m. to 4 p.m.
And the objective behind this?
Twofold, really. First, to reduce high-standing deposit facility, or SDF, balances, that's another way banks park surplus funds with the RBI. And second, to address any late-evening liquidity mismatches banks might face, gives them more time to manage their positions.
More flexibility for banks.
Significantly more. Helps them manage funds efficiently, reduce dependence on the overnight facility.
Now, something else on the RBI's balance sheet often sparks curiosity. Gold. What's happening with the RBI's gold reserves?
Yes, gold. The RBI significantly increased its gold reserves by 57.5 tons in FY25, bringing the total to a record 879.58 tons.
A record high. Is that held differently within the RBI?
It is. A substantial portion, 311.38 tons, is held by the issue department directly linked to monetary management and currency issuance, while 568.20 tons are held by the banking department, more for asset diversification.
And is this trend of central banks buying gold unique to India?
Not at all. It's part of a broader global trend. According to a recent European Central Bank report, gold has actually overtaken the euro to become the second largest global reserve asset.
Second largest. After the dollar.
Exactly. Gold now accounts for 20% of global reserves, trailing only the US dollar at 46%. Total official gold holdings globally are near the historic peak seen back in 1965. The U.S. Fed is still the largest holder, but the RBI is clearly a significant player.
Why are central banks increasing gold reserves now?
A 2025 World Gold Council survey showed 95% of central banks expect to increase their gold reserves in the next year. The reasons are compelling. Gold is seen as a long-term store of value, an effective inflation hedge. It performs well during crises, economic or geopolitical, and it's a powerful portfolio diversifier, adds stability.
Makes sense. And speaking of gold, I heard there are new rules for gold loans, something impacting borrowers directly.
Yes, the RBI released a comprehensive revised regulatory framework for both gold and silver loans, effective from April 1st, 2026. Aims to promote greater transparency and borrower protection.
What are the key changes?
Several important ones. A higher loan-to-value, or LTV cap. Borrowers can now get loans up to 85% of the gold's value for amounts up to 2.5 lakh. That's up from 75%.
Okay, higher LTV. What else?
For gold loans below 2.5 lakh, lenders won't need detailed income assessments or credit checks. Simplifies and speeds up access for small borrowers. Much more inclusive.
That's helpful. Anything on repayment?
Bullet repayment loans, where you repay principal and interest all at once at the end, are now restricted to a 12-month limit, primarily for consumption purposes. Encourages more structured repayment.
Are there limits on how much gold or silver can be pledged?
Yes, specific limits per borrower across all branches of a single lender. Up to 1 kilogram gold ornaments, 50 grams gold coins, 10 kilogram silver ornaments, 500 grams silver coins. Designed to prevent over-leveraging.
What about getting the gold back after repayment? Any changes there?
Big changes for consumer protection. Lenders must return pledged gold or silver on the same day of loan closure or within 7 working days at the absolute latest. There's a clear penalty, $5,000 per day for any delay.
That's a strong incentive.
Absolutely. Plus, mandatory compensation is required from lenders if the pledged metal is lost or damaged during storage or audit. Crucial protection.
In the auction process if someone defaults.
Made much more transparent. Requires advance notice to borrowers, and the reserve price must be at least 90% of the market value. Protects borrowers from distressed sales.
Any rules on communication? Language barriers can be an issue.
Address that too. Mandating loan terms and valuation details be provided in the borrower's local or preferred language, and crucially, in front of an independent witness for illiterate borrowers. It's about greater clarity, fairness, and protection for gold and silver loan customers. And this brings us to a really important question. How are specific sectors, specific customer groups being supported within this whole evolving framework? The RBI and others aren't just looking macro, they're drilling down with targeted interventions.
Right, tailored support. What are some examples?
One significant policy adjustment concerns priority sector lending, TSL, for small finance banks, the SFBs. The RBI reduced the PSL requirement for SFBs from 75% of their adjusted net bank credit, or ANBC, down to 60% of their total lending portfolio. That's effective April 1st, 2025.
Why the reduction? More flexibility.
Exactly. It comes with a revised allocation structure, too. SFBs must allocate 40% to various PSL subsectors. The additional PSL component is reduced from 35% to 20%, which banks can now allocate to any subsector where they have a competitive advantage or see better opportunities.
So a balance between mandate and commercial sense.
Precisely. Gives SFBs more flexibility to diversify and grow, while still ensuring a significant focus on priority sectors like agriculture, education, small businesses.
Okay. What about individual banks? Any standout performances or initiatives?
Well, looking at State Bank of India, SBI, it continues to show strong performance, particularly in household finance. Asset quality significantly improved. Gross NPAs down to 1.82%, net NPAs at a very healthy 0.47%.
Impressive numbers.
And this strong health allowed SBI to declare a substantial dividend payout of over 8,000 crore to the government. Reinforces that positive trend for PSBs. And interestingly, on a broader note, household savings are projected to hit 22 lakh crore.
Shows a strong savings culture.
A very strong savings culture. Provides a stable base for the financial system.
Any interesting initiatives focused on digital inclusion or customer engagement?
Yes. Ujjivan SFB launched Ujjivan Rewards, a loyalty program for its resident savings account holders. Customers earn points for digital transactions, redeemable across various categories.
Smart way to encourage digital use.
Very smart. Supports financial inclusion by incentivizing digital behavior, and it also helps banks strengthen their SANSA-based current account savings account, which is a stable, low-cost source of funds for lending.
Okay. And any new types of financial institutions emerging?
Yes, a notable new and specialized institution, Sagarmala Finance Corporation Limited, or SMFCL, India's first dedicated maritime sector NBFC.
Focus purely on maritime.
Yes. Launched specifically to offer customized funding solutions for critical players in the maritime ecosystem. Ports, MSMEs and maritime activities, various maritime infrastructure projects. It'll play a crucial role supporting things like renewable energy in ports, cruise tourism, shipbuilding, addressing specific financial needs in this vital sector to accelerate its growth.
That's a great deep dive into how the banking sector is strengthening, adapting, right down to these targeted support initiatives. But now let's unpack something truly transformational. I mean, if there's one story that everyone is talking about, the one that really signifies India's financial revolution, it has to be UPI, Unified Payments Interface.
Yeah.
What's the latest on its, frankly, unstoppable rise?
Indeed. UPI's growth continues to be nothing short of phenomenal, truly redefining digital payments, not just in India, but as you said earlier, globally. The latest figures from May 2025, staggering. UPI transactions crossed 25 trillion in value for the first time.
25 trillion.
Yes. And the volume hit an incredible 18.68 billion transactions just in that month. That's a remarkable 33% year-on-year jump. Shows its relentless expansion. It now accounts for a massive 83.4% of the entire payment ecosystem volume in FY25, up from 79.4% the year before.
Just dominant. Yeah.
Pervasive, ever-deepening adoption across the country. But here's where it gets truly globally impactful, the point you raised earlier. On June 2, 2025, UPI officially overtook Visa, became the world's largest retail real-time payment system by daily transaction volume.
That's the big one. How many
An
transactions?
astonishing 650 million transactions on that single day, definitively surpassing Visa's FY24 daily average of 639 million. And just for perspective, MasterCard handles around 450 million daily.
Significantly more than both.
Significantly. And it's not just volume. In May 2025 alone, UPI processed 25 lakh crore in transaction value. That's an astounding 12 times higher than the combined total of all card transactions in India.
12 times.
Think about that. One system handling 12 times the value of all card transactions. India alone now contributes a staggering 48.5% of all real-time digital transactions globally, almost entirely due to UPI.
Unbelievable market share.
And within India itself, an overwhelming 85% of all digital transactions are via UPI.
Has this drawn international attention from institutions like the IMF?
Significant recognition. A new IMF paper, Growing Retail Digital Payments, the Value of Interoperability, specifically highlighted UPI's transformative role, shifting India from cash-dependent to digitally driven. The IMF went as far as recommending UPI as a model for other countries, specifically emphasizing the value of interoperability.
Can you explain interoperability in this context?
Sure, it means different payment systems, banks, apps can seamlessly communicate and process transactions with each other, regardless of which platform the sender or receiver uses. This open-loop interbank system is a key differentiator for UPI.
How does that differ from, say, Visa or MasterCard?
Well, traditional card networks largely operate on a deferred settlement model. Transactions are batched, settled later. UPI provides real-time fund settlement directly from one bank account to another. Another crucial distinction. Visa, MasterCard often involve credit, right? UPI is predominantly a debit instrument, drawing funds directly from bank accounts.
Okay. And is UPI expanding beyond just retail payments?
Yeah.
Into other financial areas?
Yes, strategically integrated into crucial capital markets now. SEBI, the Securities and Exchange Board of India, announced a new UPI-based authentication tool to significantly enhance security and streamline transactions in the securities market, effective October 1st, 2025.
How will that work?
It means a new structure for validated UPI handles, a clear username with a category suffix like BRIC for brokers, MF for mutual funds, followed by @valid, and the bank's name. There'll also be a visual cue, a thumbs-up icon inside a green triangle during transactions. QR codes will incorporate this structure too.
But who has to use this?
All SEBI-registered intermediaries collecting investor funds, brokers, investment advisors, research analysts, they're mandated to adopt this system. There's a transition period until December 2025. SEBI also set an upper limit, up to 5 lakh per day for capital market transactions via UPI.
Sensible limit. Any other tools to boost security?
Yes, SEBI is developing a complementary tool called SEBI Check. Allows users to easily verify UPI IDs and associated bank details, further bolstering security, fostering trust in these crucial market transactions. And what's truly fascinating here, I think, is the foundational work, the stuff happening beneath the surface, the underlying digital infrastructure that's not just enabling this digital acceleration, but making something like UPI so incredibly robust, so powerful.
It's not just the app interface, it's the plumbing behind it.
Exactly. The sophisticated plumbing makes the difference. Take the Unified Lending Interface, or ULI, for example. This is being designed as a digital public infrastructure specifically for credit delivery.
ULI, what's the goal?
Its core purpose is enabling consent-based access to both financial and non-financial data from multiple diverse sources, with the ambitious aim of streamlining loan approvals significantly, making credit more accessible.
When was this announced? Is it live?
Announced by the RBI governor in 2024. The pilot began in 2023, actually, under a different name, Public Tech Platform for Frictionless Credit. It's being meticulously developed by the RBI Innovation Hub, currently in testing.
What kind of data sources does it pull from? Sounds complex.
Incredibly diverse and innovative sources, land records from state governments, GSTN data for businesses, milk pouring data from state dairy federations for dairy farmers, even satellite imagery for agricultural assessments, predicting crop yields.
Wow, satellite imagery for loans.
Yeah. Plus established tools like Aadhaar, eKYC, PAN validation, DigiLocker for documents, account aggregators for financial data, property search data, CGTMSE data. It pulls it all together.
What are the initial use cases? How is it being applied?
Already integrated some impressive use cases, demonstrating its potential. For instance, digitalizing Kisan Credit Card, KCC, lending for over 120 million farmers, making it easier, faster for them to get agricultural credit. Also streamlining cattle financing for 80 million dairy farmers, a critical rural segment.
This could be revolutionary for credit access.
Absolutely, particularly for underserved segments who struggled with formal credit due to lack of collateral or documented history.
Okay, ULI is one piece. What other foundational infrastructure is being upgraded?
Another critical piece undergoing a significant upgrade is the National Automated Clearinghouse, or NACH. NPCI, the National Payments Corporation of India, is set to launch NACH 3.0 in July.
NACH, that handles recurring payments, right?
Yeah.
Salaries, EMIs.
Exactly. A robust electronic clearing system launched in 2016 for high-volume, recurring transactions like salaries, pensions, EMIs, utility bills, insurance premiums. NACH 3.0 brings a comprehensive suite of enhancements.
Like what? What's new in 3.0?
A new graphical user interface, better navigation, enhanced capability for even higher transaction volumes, real-time dashboards for banks to monitor transactions, self-service account management for users, end-to-end encryption for all data transfers, mandatory multi-factor authentication, MFA, for all users. Big security boost.
Security seems key.
Definitely. Also, robust role-based access control to prevent unauthorized data use. File downloads will now only be PGP encrypted. Pretty good privacy encryption, plain text downloads disabled. Real-time alerts, enhanced audit trails to detect irregularities swiftly. It's all about making that underlying system for mass recurring payments even more robust, secure, and efficient for millions of daily transactions.
That's incredible foresight, building out these foundational layers which truly underpin the digital revolution. But here's where it gets particularly interesting, maybe a bit concerning, because with all this digital growth, there's always the rising challenge of fraud, isn't there?
Absolutely.
So how is India tackling that? What measures are being put in place to keep all these digital transactions secure and trustworthy?
You've hit on an absolutely critical point. As digital adoption skyrockets, so does the sophistication of digital frauds. It's a constant cat-and-mouse game. To combat this, the RBI, in a significant collaboration with major public and private sector banks, is launching the Digital Payment Intelligence Platform, or DPIP.
DPIP.
What will that do? It's being developed as a digital public infrastructure specifically to strengthen fraud risk management across the entire digital payment ecosystem. The Reserve Bank Innovation Hub, RBIH, is building a prototype in consultation with select banks, essentially creating a central intelligence hub to detect and prevent fraud more effectively, more proactively.
So sharing intelligence to fight fraud.
That's the core idea. This follows key recommendations from a committee chaired by A.P. Hoka, former head of NPCI, formed by RBI in June 2024, highlights the urgency and systemic importance.
And the statistics show this is needed, right? What did the latest RBI report say about fraud?
The latest stats from the RBI's FY25 report underscore the scale. Total bank frauds increased to 36,014 crore in FY25. But the breakdown is crucial. In terms of sheer number of frauds, digital payments cards, internet predominated.
Okay, high volume of small digital frauds.
Right. But in terms of the value of the frauds, the loan portfolio, specifically advances, was the primary category.
So the big money losses are still in loans?
Largely, yes. It paints a complex picture. Individuals face many digital payment scams, but the larger financial impact often comes from more sophisticated loan-related frauds. Private banks reported most fraud cases in card internet, while public sector banks faced most fraud value in advances. Suggests different risk profiles, areas for targeted intervention.
Got it. And are there specific measures for systems particularly vulnerable to fraud, like the Aadhaar payment system?
Yes, APS. To specifically address security within Aadhaar-enabled payment system, which is widely used for financial inclusion, the RBI issued final guidelines for APS touchpoint operators, effective January 1st, 2026.
APS, that's using Aadhaar and biometrics for basic banking.
Exactly. Launched by NPCI in 2016, lets people in remote areas do basic banking via a local touchpoint operator. These new guidelines significantly tighten onboarding and monitoring norms for these operators.
Why the tightening? Fraud issues there too.
Yes, unfortunately. The objective is clear. Strengthen fraud risk management, enhance security. There have been rising cases of identity theft, credential misuse, impacting vulnerable populations.
So what are the new requirements for these operators?
Comprehensive and stringent. Acquiring banks, the ones deploying these touchpoints, must conduct comprehensive due diligence on all operators, business correspondents, bank mitras, aligning strictly with RBI's KYC norms.
Stricter vetting.
Yes, and any operator inactive for 3 consecutive months needs fresh KYC before resuming. Ensures an up-to-date, verified network. A significant structural change is the one bank rule.
One bank rule.
Each APS operator can only work with one acquiring bank, enforced by NPCI and banks, designed to streamline oversight and accountability.
Makes sense. What about monitoring transactions?
Banks are mandated to continuously monitor operator activity, robust transaction monitoring systems, setting transaction limits based on risk profiles, implementing real-time anomaly detection to swiftly prevent and respond to fraud. All APS participants must comply. Ensures a much more secure environment for millions, especially in rural and semi-urban areas. Now, this raises another important question. Amidst all these digital payment innovations, security measures, what about India's own digital currency, the e-Rupee, the central bank digital currency, or CBDC? Where does that stand in this rapidly evolving landscape? And what are the practical implications for you, the user?
Right, the e-Rupee, how's that progressing?
It's been making quiet but steady progress since its pilot launch. It crossed a 14 euro crore in circulation by March 2025. It was initially launched back in 2022 as a pilot, for select wholesale and retail users. Allowed the RBI to test functionality, security, impact in a controlled way before a wider rollout.
And how does it actually work for a user?
It's issued in denominations just like physical coins and notes. Users access it through digital wallets provided by participating banks. Importantly, it's designed as a fungible digital token.
Fungible meaning?
Each unit is identical and interchangeable, just like physical cash in your wallet. What's particularly significant for financial inclusion is that users don't necessarily need a traditional bank account to use the retail e-Rupee. They can operate it solely through a digital wallet.
That's huge for reaching the unbanked.
Huge implications. In the wholesale segment, it's already being used successfully for interbank settlements and secondary market transactions in government securities, streamlining large value transfers, reducing settlement risk.
Okay. What about taxes? That's often a point of confusion with digital currencies. How is the e-Rupee taxed?
Good question, needs clarification. The e-Rupee is explicitly classified as sovereign legal tender, meaning it's a direct liability of the central bank, holds the same legal status as physical cash.
So not like crypto.
Crucially, no. It is not considered an investment asset, a cryptocurrency, or a virtual digital asset. Consequently, it's not subject to income tax or GST in the same way an investment or service might be. It falls outside those capital assets and virtual digital assets definitions under tax laws.
Does it earn interest?
No. Unlike bank deposits, the e-Rupee doesn't earn interest, and it can't be traded or transferred for consideration. Its sole purpose is facilitating payments and transactions.
Okay, so no direct tax. But are there any hidden tax pitfalls? Situations where using it might cause issues?
Yes, despite its tax-exempt status, there are potential pitfalls users and businesses need to be keenly aware of, primarily because it's treated as a cash equivalent in many scenarios.
Like what? Give us some examples.
Okay. If a business makes expenditure payments in e-Rupee exceeding 10,000 to one person in a day, that expenditure might be fully disallowed as a tax deduction.
Right, like the cash payment rule.
Exactly. Similarly, businesses could lose eligibility for certain audit exemptions if more than 5% of their total receipts or payments are in digital currency treated as cash. If you pay health insurance premiums using e-Rupee, it may not be eligible for tax deductions.
Okay.
Donations over 2,000 in digital rupee might also not qualify for tax benefits. There are prohibitions on receiving or repaying loans or deposits over 20,000 in a day using e-Rupee. Even larger transactions involving receipt or repayment over 2 lakh in cash equivalent forms may be disallowed or penalized.
So treat it like cash for these limits.
Pretty much. And finally, just like physical cash, withdrawals using digital rupee might attract tax deduction at source, TDS, if treated similarly to cash withdrawals over certain thresholds. These nuances are absolutely vital for compliance, avoiding unintended tax consequences.
That's a critical breakdown of the e-Rupee, especially those potential tax implications. Highlights the subtle differences. Okay, and what about connecting India's digital payments prowess to the rest of the world? Are we seeing that integration happen for cross-border transactions?
Absolutely. Cross-border payments are another area seeing significant regulatory and operational advancements, crucial for India's growing global trade and service exports. The RBI had, back in October 2024, issued a clear mandate. All payment aggregators facilitating cross-border payments need separate, distinct approval.
Separate from domestic licenses?
Yes. Ensures proper oversight, regulation of these international financial flows, maintaining integrity, security.
And have companies receive these approvals?
Yes, we've seen major global players getting their approvals. Signals growing confidence in India's regulatory framework and market. PayPal payments, Worldline e-payments, India, and Wise have all received in-principle approval from the RBI to operate as cross-border payment aggregators.
Okay, big names.
Right. Specifically, PayPal got approval as a payment aggregator, cross-border exports, PACBE. Indicates its strategic focus on facilitating outbound transactions from India.
And what's the scope of this authorization? What does it enable?
Significant and far-reaching scope. allows these companies to seamlessly facilitate cross-border online transactions for both import and export of goods and services, streamlining international trade, digital commerce for millions of businesses.
And importantly for freelancers and SMEs.
Crucially, yes, it empowers these non-bank payment companies to serve that vital growing segment. Freelancers, SMEs, software service exporters who frequently engage internationally. They need efficient ways to send and receive payments. This move significantly reduces friction, lowers transaction costs, increases speed for them.
Makes it easier to get paid from abroad or pay suppliers globally.
Considerably easier. Enhances India's global trade integration. It's truly a step towards a more interconnected digital economy. Now, shifting gears a bit to the capital markets, what's truly fascinating here is the suite of measures SEBI, the Securities and Exchange Board of India, is rolling out. Their approach seems dual-focused.
How so?
Not only making investing easier, more accessible, but also actively steering capital towards more sustainable avenues. It's a comprehensive approach.
Yeah.
Efficiency and responsibility.
Okay, let's start with investment facilitation. What's happening there?
Let's look at the National Investment and Infrastructure Fund, NA. The 6th Governing Council meeting, chaired by the Finance Minister, reviewed plans. There's an exciting proposed bilateral fund under discussion with the USA.
For infrastructure.
Could open significant new doors for cross-border investment, specifically in India's critical infrastructure. The Council also noted progress on NEF's upcoming private markets fund, to target corpus of $1 billion.
Can you quickly remind us what NIF is?
Sure, it's a unique quasi-sovereign wealth fund. 49% government-owned, 51% global institutional investors. Founded 2015 HQ Mumbai under Ministry of Finance. Manages 4 funds. A master fund for core infrastructure, a fund of funds, a strategic opportunities fund, and the India-Japan Fund, its first bilateral one, focused on climate, sustainability.
So strategically deploying capital.
Significant capital into vital sectors for long-term growth.
You mentioned sustainability. What's SEBI doing on the ESG front?
A strong, progressive move towards sustainable finance. SEBI issued a detailed operational framework for ESG debt securities, effective June 5, 2025. Structures the issuance of social bonds, sustainability-linked bonds.
What's the goal?
Clear and pressing. Facilitate much-needed funding for sustainable projects. Help bridge the significant SDG funding gap in India. Applies to public issues, private placements, mandates proceeds must strictly go to eligible sustainable projects.
How nature of that?
Requires initial disclosures and offer documents, continuous disclosures and annual reports, transparency, accountability. Crucially, independent third-party reviewers must verify alignment with recognized ESG standards. Adds credibility.
What if a project has both social and environmental benefits?
SEBI pragmatically recognizes that overlap. Social projects might have environmental co-benefits, vice versa. The bond's classification depends on the primary objective of the underlying projects, provides necessary flexibility.
Okay. Any changes regarding alternative investment funds, AIFs?
Yes, SEBI relaxed some investment norms, specifically for Category 2 AIFs. These are private equity, debt funds, investing in unlisted private companies, debt securities.
What's changed?
Minimum investment threshold for investors stays 1 crore, managers 25 lakh. But SEBI corrected the investor limit to 1,000 per AIF scheme, except angel funds, which remain at 200. Aims to broaden participation, liquidity in these specialized funds.
Anything on offshore derivative instruments, ODIs?
Just an extension. SEBI extended the compliance timeline for granular disclosure requirements by ODI subscribers to November 2025, gives market participants more time.
And I heard about reforms for REITs, InVITs, and merchant bankers to ease business.
Yes, several crucial reforms. For REITs and InVITs, related parties are now excluded from the public category for certain purposes unless they're qualified institutional buyers. Clearer distinction prevents conflicts.
What about how they handle income and losses?
Significant change here. A holding company, holdco, can now adjust its own losses against income received from its special purpose vehicles, SPVs, before distributing to the REIT or NVT. Previously, they had to pass on 100% of SPV cash flow, regardless of holdco losses. That was operationally difficult, tax inefficient.
That sounds more logical.
It is. Reporting timelines for quarterly reports, valuation reports are now synchronized with financial results, improves efficiency, reduces compliance burden. Also, the minimum allotment lot for privately placed NVTs in primary market is reduced significantly to 25 lakh, aligns with secondary market norms, broadens investor participation potentially.
And for merchant bankers? More flexibility for them.
Yes, amended regulations allow them to carry out non-SEBI regulated activities within the same firm under specific conditions. Big step towards consolidating financial services. Includes activities regulated by other financial sector regulators, FSRs, and fee-based, non-fund-based services outside any FSR's purview. Broadens their operational scope judiciously.
Offering more services under one roof.
Exactly. Finally, SEBI also approved a co-investment vehicle, or CIV, framework under AIF regulations. Innovative framework allowing AIFs and their accredited investors to co-invest directly in unlisted companies alongside the fund. More flexibility, choice for joint investments, potentially attracting more capital into private markets.
That's a truly extensive list of strategic changes. Attracting investment, streamlining processes across capital markets. But beyond just ease of doing business, what steps are being taken to ensure the markets remain fair, secure, transparent for everyone? From big institutions down to individual investors.
Ensuring market integrity, robust investor protection, that's a continuous evolving priority for SEBI. One step, the mandate for product advisory committees, PACs, in commodity exchanges.
Now PACs, what's the change?
SEBI now mandated these committees must convene at least twice a year, effective June 2025. For agricultural commodities, minimum is once a year due to seasonality. Mandates greater oversight, regular stakeholder input on market ops, product development, risk management in the vital commodity derivatives segment.
Ensures expertise and input.
Right. Each exchange needs a separate PAC for each distinct commodity group, involving common stakeholders, shared value chain participants, maintaining a 50% quorum for effective decision-making.
What about direct help for investors? Education and resolving issues.
On that front, SEBI, collaborating with the Investor Education and Protection Fund Authority, IEPFA, launched the first Nivshak Shavir in Pune.
Nivya Shavir, Investor Camp.
Essentially, yes, designed to directly assist investors with critical, often frustrating issues. Reclaiming unclaimed dividends, updating KYC info, addressing various investment-related claims. Provides a direct, accessible channel for investors to resolve issues, enhance understanding, build trust.
That sounds useful. Any changes in the insolvency process? That impacts creditors and asset recovery.
Yes, a significant amendment from the Insolvency and Bankruptcy Board of India, IBBI. They've amended regulations to allow resolution professionals, the ones overseeing insolvency, to invite resolution plans for individual asset sales of a corporate debtor.
Previously, it was mainly selling the whole company.
Primarily, yes. Now, professionals can invite plans for the entire company or for one or more specific assets, or even a combination, subject to approval from the Committee of Creditors.
What's the objective here?
Twofold. First, facilitate quicker, more efficient resolution of large, diversified debtors by allowing piecemeal sale if that maximizes value. Second, attract a broader pool of sector-specific buyers interested in particular assets, not the whole company. Potentially better realization for creditors, more efficient capital allocation.
More flexibility in finding buyers.
Exactly. The amendments also allow the Committee of Creditors to direct the resolution professional to invite interim finance providers to attend meetings as observers. More transparency, stakeholder engagement. And this raises an important question. Beyond these broad market integrity measures, who are the new key players shaping the market? What's happening with some of the big public offerings that could redefine structures and investor opportunities?
Right. Any major new entrants?
A significant development. SEBI approved Jio-BlackRock Broking PVT Ltd. to commence operations as a stockbroker. Marks the entry of a powerful new player.
Jio and BlackRock. That's
Right.
a big combination.
Huge. It's a wholly owned subsidiary of Jio-BlackRock Investment Advisors PVT Ltd. itself, a 50.50 joint venture between Jio Financial Services and the global asset management giant BlackRock Inc., USA. Incorporated January 2025, initial investment 25 crore. Signals serious intent.
Is this their first approval?
Actually, the third regulatory clearance for this partnership follows earlier approvals for asset management and investment advisory businesses. This brokerage approval positions them to provide comprehensive investment solutions, advisory, mutual funds, now brokerage, a holistic financial platform.
And BlackRock's scale is massive.
Absolute behemoth. Manages assets worth $11.58 trillion globally as of March 31. This marks BlackRock's significant re-entry into India after exiting in 2018. Shows immense confidence in India's growth story.
What about IPOs? Any big ones on the horizon, especially from MBFCs?
Yes, major movements in the IPO space, particularly from prominent non-banking financial companies, indicates growing maturity, investor appetite. HDB Financial Services, a key subsidiary of HDFC Bank, received SEBI approval for a substantial IPO. valued at 12,500 crore.
That's a big one. How's it structured?
Includes a 10,000 crore offer for sale, OFS, existing shareholders, mostly HDFC Bank, selling shares, and a 2,500 crore fresh issue, injecting new capital into the company. HDFC Bank will retain a majority stake, complying with RBI norms for upper-layer NBFCs.
Any others?
Tata Capital is also reportedly preparing for an even larger IPO, maybe 15,000 crore. These anticipated offerings underscore the increasing maturity, robustness, investor demand for India's NBFC sector, plays a crucial role in credit dissemination.
Any interesting international listings happening in India?
Yes, on the green finance front, DFCC Bank from Sri Lanka achieved a notable milestone, became the first foreign corporate to list green bonds at GIFT IFSC.
In Gujarat's financial center.
Right. Strategic move by DFCC Bank aimed at funding vital solar energy projects. Demonstrates how India's financial hubs are increasingly attracting global capital for sustainable development, promoting green finance across the region.
That's fascinating. New global players, green finance taking root. So what about encouraging India's vibrant startup ecosystem and also maybe making it easier for public sector companies to operate?
Yeah.
Are there specific targeted changes aimed at them?
Absolutely. SEBI made some very specific, impactful changes for both startups and public sector undertakings, PSUs. For startup founders, SEBI notably relaxed norms concerning employee stock ownership plans, ESOPs, during an IPO.
ESOPs. How have the rules changed?
Previously, promoters generally weren't allowed to hold ESOPs when filing their draft red herring prospectus, the DRHP, for an IPO. They usually had to liquidate them. A disincentive. Now, SEBI relaxed this, allowing startup founders to retain ESOPs granted at least 1 year before filing the DRHP.
Why is that important for startups?
Crucial change. ESOPs are a key tool for aligning founder interests with company success, retaining top talent. However, the board clarified, no new ESOPs can be issued to promoters post-listing. Ensures the benefit is for pre-IPO founders, avoids potential governance issues later.
Okay. Anything else to help startups list or raise funds?
Yes. Related move aimed at facilitating broader participation in offer for sale, OFS, during IPOs. SEBI extended the exemption of the 1-year holding period for equity shares arising from converting fully paid up, compulsorily convertible securities, or CCS.
CCS conversion helps who participate in the OFS.
Enables holders of these converted shares to participate in the OFS without waiting a year. Broader participation. These changes collectively align with SEBI's broader objective. Enhance ease of doing business. Actively encourage startup reverse flipping.
Reverse flipping, bringing startups back to India to list.
Exactly. Shifting incorporation from foreign jurisdictions back to India to list domestically. Significant policy push to bring Indian startups home, ensure they contribute to India's capital markets.
Okay. And what about public sector undertakings, PSUs? Any changes for them?
Yes. SEBI approved a special rule allowing government-owned companies to voluntarily delist from stock exchanges, but under very specific conditions.
What are the conditions?
Only if the government already holds over 90% stake in the PSU. It's a targeted rule, applies to only about 5 PSUs currently. Importantly, excludes banks, NBFCs, insurance companies due to their distinct regulatory frameworks.
How does the delisting process change for them?
Significantly. PSUs can now delist at a fixed price, regardless of whether their stock is actively traded. This fixed price must be at least 15% more than the minimum or floor price, ensures a fair exit for remaining public shareholders.
What about shareholder approval?
That's the other big change. The usual rule of needing 90% total promoter plus public holding is relaxed. And critically, public shareholder approval, typically needing a 2/3 majority vote, is also no longer mandatory.
Why these relaxations?
Specifically designed to provide greater flexibility for the government in managing its holdings in PSUs, potentially for strategic restructuring or disinvestment. Simplifies the delisting process under these precise high ownership conditions. And if we connect this to the bigger picture, SEBI isn't just regulating market participants, it's also actively refining its own internal governance, its operational environment, to be more efficient, transparent, responsive.
The regulator regulating itself, in a way.
Exactly. Ensures the regulator itself is agile enough to manage India's rapidly evolving financial ecosystem effectively. A significant internal appointment recently. Anuradha Thakur to the SEBI board as a part-time member, effective July 1st.
I'm replacing O.J. Seth.
Yes, who is retiring. This appointment is notable not just for her expertise, but because she's the first woman appointed as Economic Affairs Secretary. Highlights a positive push for diversity at senior levels of financial governance.
And her role connects SEBI to broader policy.
Yes, the SEBI board includes the RBI Deputy Governor, the Economic Affairs Secretary, her role, and the Corporate Affairs Secretary as part-time ex officio members. Her role provides a crucial direct link between SEBI's functions and the government's broader economic policy apparatus.
Okay. Any changes making life easier for market intermediaries, like investment advisors or research analysts?
Yes, a practical move to ease operational difficulties. SEBI approved new options for investment advisors, IAs, and research analysts, RAs, to meet their deposit norms. Historically, they needed a deposit with a bank, often an FD. Now they can choose to use liquid mutual funds and overnight funds as alternatives.
Why the change? What were the difficulties?
Aim to alleviate issues like confusion in FD procedures across different bank branches, practical difficulties marking FDs as security. This operational flexibility is a direct response to industry feedback.
Building on earlier reforms.
Yes, builds on earlier reforms from December 2024 that eased qualification requirements, allowed certification via continuing education, removed rigid experience net worth requirements, replacing them with this deposit norm. And in March 2025, fee regulations were relaxed, allowing advance fees for up to 1 year. More stable revenue.
So fostering a more business-friendly environment.
Collectively, yes. Less cumbersome for these key players, ultimately benefiting investors.
Anything else on the regulatory front? Maybe for older fund structures?
Finally, yes, SEBI launched a targeted one-time settlement scheme specifically for venture capital funds, VCFs, that delayed winding up their schemes.
For VCFs that didn't close on time.
Exactly. Applies to those VCFs that have since migrated to SEBI's AF regulations. Aims to provide a clear, one-time chance to resolve past non-compliance on winding up without unduly burdening investors.
Is there a fee involved?
Yes, a tiered settlement fee structure, ranging from 1 lakh for delays up to 1 year, plus 50,000 per year of delay, plus a variable amount based on unliquidated investment size. Deadline was January 19, 2025. Underscores SEBI's commitment to orderly closures, compliance within the dynamic alternative investment space, fostering accountability.
Wow. That's a truly detailed look at the core financial sector, banks, capital markets, even the regulators themselves. But beyond the numbers, beyond the financial mechanisms, what do these reports tell us about India's social progress, about the living standards of its people? How are people actually experiencing these economic changes on the ground?
It's absolutely crucial to connect these shifts to their real-world impact. And there's some very positive news regarding poverty reduction. According to a recent World Bank poverty assessment, India's poverty rate significantly fell to 5.25% in 2022-23.
5.25%. Measured how?
Measured under the international standard of the $3-day PPP line purchasing power parity, this is a truly dramatic decrease from 27.12% back in 2011-12.
That's incredible progress.
Profound progress, lifting millions out of poverty over, a little more than a decade. This improvement is also clearly reflected in rising monthly per capita expenditure, or MPCE, key indicator of household consumption, living standards.
What are the MPCE numbers?
In rural areas, it rose to 4,122. In urban areas, it reached 6,996. Importantly, the assessment highlights declining inequality and a narrowing of rural-urban consumption gaps, suggests economic gains are becoming more broad-based, more inclusive.
What does the World Bank attribute this to?
Explicitly attributes this strong evidence of real progress to improved governance and significant data reforms, signaling effective policy implementation, a genuine commitment to social development.
Okay, that's positive. But
Yeah.
Are there any areas of concern on the social front, maybe related to spending or safety nets?
There are some anxieties, yes. Regarding Social Security spending, specifically around the Mahatma Gandhi National Rural Employment Guarantee Scheme, MGNRGS, the center capped the MGNRGS spend to 60%, or 51,600 crore, for the first half of FY26, out of the total 86,000 crore annual budget.
Why is that causing concern?
Concerns raised among some regarding potential pending dues to workers, delays in wage payments, directly impacts the most vulnerable rural populations who rely on this scheme for livelihoods as a crucial safety net.
Okay. Any other initiatives related to Social Security or compliance?
Yes. To address compliance issues and disputes, the Employees State Insurance Corporation, ESIC, announced a one-time amnesty scheme, running from October 2025 to September 2026. Aims to settle outstanding disputes, reduce litigation, provides a window for employers to regularize contributions without severe penalties.
And expanding coverage.
Alongside this, the SFBs scheme has been relaunched, designed to expand coverage, bring more workers under the Social Security net, ensuring a broader reach of benefits. Now, what's truly fascinating, I think, is how India is blending traditional agriculture with cutting-edge technology and progressive policy reforms. A concerted push to modernize, invigorate its vital agricultural sector, the backbone of the rural economy.
Right, agriculture's key. What's happening on the digital front there?
A major thrust in the digital agriculture mission. The recent AgriStack National Conference reviewed significant progress, focusing intently on establishing a comprehensive farmer registry, integrating Aadhaar with its unique digital identities for farmers.
What's the goal of AgriStack?
Building robust digital value chains, DVCs, seamlessly linked with existing government schemes like PM Kisan, which provides financial support. States like Maharashtra, UP showcased impressive innovations. AI tools for crop advisory, interactive chatbots, advanced remote sensing apps, demonstrating how tech is deployed on the ground to empower farmers with timely, accurate information.
Is technology also changing how crop yields are estimated?
A significant leap here, satellite-based Kharif crop estimation. From September 2024, the traditional, often labor-intensive manual Gurdwari crop inspection acreage estimation will be replaced by sophisticated satellite imaging for Kharif acreage.
How accurate is that?
Promises an impressive 93–95% accuracy, follows successful full digital crop surveys already done in states like UP, MP, Gujarat, Odisha during the 2024 season, means more precise, real-time data for policymaking, crop insurance, resource allocation.
India is also using tech for climate change solutions in agriculture.
Yes, showcase commitment by hosting its first international hackathon in Pune, specifically promoting tech-based agri-solutions for climate change. Highlights focus on leveraging collaborative innovation to tackle pressing environmental challenges, ensure agricultural resilience.
What about renewables in agriculture? Solar power.
The National Agri Summit 2025 emphasized the crucial role of renewables, promoting schemes like PM Kusum, encouraging solar pumps, and broader adoption of solar panels for agricultural energy needs. Union Minister Shivraj Singh Chauhan highlighted 6 key areas for farmer prosperity.
Such as?
Optimizing production, reducing cultivation costs, ensuring fair prices, adequate compensation for crop losses, encouraging diversification, balancing fertilizer use, a holistic approach.
And the NABARD, the Agriculture Development Bank, what are they doing?
Several key initiatives. Government approved NABARD to raise 19,500 crore via zero-coupon deep discount bonds, maturing in about 11 years, to mobilize significant long-term funds for rural agricultural development projects.
Any focus on green projects?
Yes, NABARD is launching an innovative green lending facility. Plans to lend 10,000 crore in FY26 for green infrastructure, ethanol production, EVs in rural areas, directly supporting SDG-linked initiatives, promoting a greener economy.
What about specific support for farmers? Training.
NABARD, collaborating with iCarnirka, launched a targeted training program for spice farmers in East Godavari, focusing on post-harvest technologies for turmeric, chili, to enhance quality, reduce waste, improve export potential, boost incomes.
Are there international collaborations happening in agriculture too?
Flourishing, actually, showcasing India's growing global role. ICRSAT and RISE launched the Center of Excellence for South-South Cooperation in Agriculture, ISCA, aims at developing policy models, tech transfer for drylands, agriculture across developing nations, digital knowledge sharing.
Any focus on specific crops, like turmeric?
Yes, the National Turmeric Board inaugurated in Nizamabad, Telangana. Ambitious goal, $1 billion in turmeric exports by 2030, focusing on global quality standards, brand promotion, eliminating inefficient middlemen.
Other international partnerships.
India and Ukraine held their first joint working group on agriculture, focusing on digital agri, food processing, genome editing, market access. IFCO, the fertilizer cooperative, entered a groundbreaking JV with NanoFert for a nano-fertilizer plant in Brazil. Capacity 4.5 m-liters per year. Trials show 7–10% higher yields, 20% less traditional fertilizer use. Transformative impact.
Nano-fertilizers going global.
Exactly. And India will host CIP's South Asia Center in Agra, a regional center for climate-resilient potato and sweet potato, focusing on nutrition, productivity, value chains for these staple crops, addressing food security.
And underpinning all this is agri-tech infrastructure, drones, etc.
Robust development there. Garuda Aerospace launched a cutting-edge drone facility in Chennai, manufacturing capacity, 1 lakh drones annually, established 300 centers of excellence nationwide, launched the trainer program for certified instructors, all supporting widespread adoption of precision farming, indigenization in agri-tech.
That's an incredibly comprehensive, forward-looking commitment to modernizing agriculture. Covers everything from drones to international partnerships. And finally, beyond these core sectors, what's happening to boost skills and provide targeted support across other vital areas of the economy.
Beyond agriculture, there's significant sustained movement in skill development and targeted sectoral support. Recognizing a skilled workforce is foundational to sustained economic growth. The Asian Development Bank, ADB, approved a substantial loan, $109.97 million for the Gujarat Skill Initiative.
What will that fund?
Instrumental in significantly upgrading industrial training institutes, ITIs, across Gujarat, establishing new centers of excellence. Objective: ensure vocational training aligns closely with current industry needs, future job demands. Bridging the skill gap. Part of ADB's broader commitment active portfolio in India is $16.5 billion, focusing on rural employment sustainability.
What about the textile sector? Major employer exporter.
Crucial sector. A new textile export task force has been formed. Primary objective: strategically address bottlenecks hindering exports, ensure compliance with evolving ESG standards in global markets, fundamentally enhance overall export competitiveness of Indian textiles, vital for sustaining growth.
Any measures to protect domestic industries?
Yes, to protect local manufacturers, promote indigenous production, anti-dumping duties ranging 27% to 63% were decisively imposed on plastic machinery imports from China and Taiwan. Safeguards local industries against unfair competition from cheap imports, supports Make in India.
Okay. And finally, any big news from the e-commerce sector, besides payments?
Landmark development, actually. Flipkart became the first Indian e-commerce company to receive a non-banking financial company, NBFC, license from the RBI.
Flipkart getting an NBFC license. What does that allow them to do?
It's a game changer. Flipkart Finance Private Limited can now directly offer credit facilities, like equated monthly installments, EMIs, personal loans, without needing to tie up with external banks or other NBFCs for every transaction.
So direct lending on their platform.
Exactly. Significant shift. Empowers Flipkart to provide direct, seamless credit support for consumer purchases and also for its vast network of seller operations. Streamlines financing for millions of customers and merchants. It's important to note this is a lending-only NBFC license. They cannot accept public deposits. Maintains a clear regulatory distinction.
Wow, we've truly covered so much ground today. It's genuinely incredible, isn't it, to see the dynamic nature of India's financial and economic progress just unfold before our eyes.
It really is moving at pace.
From those sweeping improvements in the health and performance of public sector banks, which, let's face it, were once seen as a drag on the system, to the pervasive, globally influential impact of the digital payments revolution led by UPI.
Which we can't overstate.
And all the way to the nuanced, proactive regulatory environment being shaped by both the RBI and SEBI. Each piece of news, each carefully considered policy shift, truly reflects a country rapidly evolving, adapting, innovating, responding to both global and domestic challenges.
A lot of deliberate action.
Understanding these interconnected developments, I think, is absolutely crucial for anyone keen on the Indian economy, whether you're an investor, a business professional, or simply, a curious mind following global trends.
Indeed. What we've seen today isn't just a collection of isolated financial news headlines, right? It's a deeply integrated strategic approach, fostering growth, ensuring stability, driving financial inclusion on, frankly, an unprecedented scale. India is clearly building a robust, modern financial architecture.
So looking ahead,
Well, given this rapid pace of digital innovation we've discussed and that adaptable, forward-looking regulatory framework, how might these trends reshape not just India's economic future in the coming years, but also perhaps serve as a practical blueprint, maybe even an inspiration for other developing economies navigating their own complex paths to digital transformation and comprehensive financial inclusion? It's a question, I think, that truly invites deeper contemplation on the global implications of India's remarkable journey.